Good morning, everyone. We're going to give it a couple more minutes just to have everyone log on, and then we'll start probably in 3 minutes or so. Okay, good morning, everyone. We're going to get started now. To introduce myself, I'm Jennifer Morose. I'm the partner in charge of employee benefit plan audits here at Saks. We're here this morning to discuss some year-end tax planning strategies. So some housekeeping items, which are on the screen right now, which you can all read. I'm sure you've all been at our webinars. I'm not going to read this out to you again. So we have Joy Mattock, who is the partner in charge of Trust and Estates, and Greg Munn from Saks Wealth Advisors. For everyone who is wondering, the presentation is being recorded and the slides will be made available to all who attend. So today, on today's agenda, we're going to talk about why estate planning should continue. I know at the end of last year, there was a big push with the potential changes. We're going to talk about today why we should still continue to have this discussion. We're going to talk about charitable planning strategies, portfolio allocation for tax efficiency, year-end capital gain distributions, RMDs, Roth conversions, opportunities to reduce taxable self-employment income. We're going to go over different types of employee benefit plans and how they can be used to reduce your taxable income, and we're going to talk about the Inflation Reduction Act impact. So our first presenter is going to be Joy. So I'm going to turn it over to you, Joy.
Thanks, Jen. Hi, everyone. It's great to be with you today to talk about estate planning, which is a subject that is near and dear to my heart. And I'm very excited to talk about all the reasons why estate planning should continue, even though it looks like we're probably not going to have a major tax plan in 2023, certainly not in 2022 before the end of the year. So some simple estate planning ideas you might want to consider. The annual exclusion is currently $16,000 per person per year, tax-free. So what that means is that Jen can write a check for $16,000 to each of me and Greg without having any estate or gift tax implications whatsoever. Because Jen is married, if her husband were to agree, she could actually write a check for $32,000 to me and to Greg, and to each one of our family members. So Jen, I'll be providing my address to you at the end of this presentation so that you can take care of that right away. But there'll be no gift tax consequences to that transfer. So you can see the power in this kind of gift giving. And this really is supposed to be for the entire year, right? So, you know, grandma makes gifts throughout the year. I mean, if your mother or mother-in-law is anything like my mother and mother-in-law, she's probably giving your kids lots of, hair ties and bows and stuff. But some grandmothers actually write checks, and you would actually have to add those up each year per grandchild to make sure that you were under the $16,000 per year. Now, the advantage is, or there's another advantage to this $16,000 per year, and that's in using that to make 529 gifts. 529 plans is a tax-favored strategy or tax-favored plan that can be used to save money for secondary education primarily. So it can be used to save up dollars that can then be used to pay tuition, usually directly, from the 529 plan, or it goes from the 529 plan to the parent and then out to the school. And you can accelerate your $16,000 gifts by making 5 years worth of 529 gifts before the end of the year. And the advantage there is that you can do that per child or per grandchild or great grandchild if you're so blessed. Additional things that you need to, can you go back to that slide? The additional things I would want to point out is that everyone should really be evaluating life insurance plans. Now, the exemption currently is at $12,060,000 per taxpayer. So that's $24,120,000 that you can give away in the aggregate during your lifetime or at your death. So that's a pretty high number. Most people are not going to run into an estate tax on their death, given these high thresholds. However, this is a factor of the Tax Cuts and Jobs Act that had been enacted at the end of 2017. And because of a Senate rule known as the Byrd Rule, Congress had to enact it using budget reconciliation and had to make sure that it expired within 10 years. So the law within 10 years, but it can be less than that. And in this case, the exemption is going to be cut in half essentially in January of 2026. So we're going to expect that number to be going up every single year. The $12,060,000 will continue to go up per taxpayer every single year. And then at the end of 2025, we're going to be talking to you about all the reasons you need to do planning, or at least I expect to, because in 2026, it's going to essentially be cut in half. Now, what does that have to do with life insurance? Well, life insurance is not included in your estate unless you own it on your own life. So to take an example, let's assume that Greg owns a life insurance policy on his own life, and that life insurance policy is going to pay out $5 million. If he were to pass between now and 2025, he's going to have an asset worth $5 million in his estate. Now, of course, if he continues to own it beyond that, it's also going to be an asset worth $5 million in his estate, which is kind of a shady deal if you think about it, because life insurance proceeds are by definition an asset that you actually never get to benefit from during your lifetime. So it seems completely unfair that you should have to pay a tax on your death for having owned the policy. So it's always better to have that life insurance policy owned by someone else. So the window we have between now and the end of the year is for if Greg were, instead of owning that policy, going into 2023 and beyond, if he instead were to set up a life insurance trust, name Jen as the trustee, transfer the policy to Jen, and then so long as Greg survives until 3 years from the date that he transferred that policy, so around now 2025, then the policy, the proceeds will not be included in his estate. And I think that it's really important to move those life insurance policies now, because maybe a $5 million asset in Greg's estate before 2025 won't be that devastating. Maybe he won't have an estate that's large enough to have an estate tax, even with the $5 million life insurance policy that he tried to transfer out. But once 2026 rolls around and the exemption is cut in half, essentially about $6.5 million exemption, that $5 million life insurance proceeds could be particularly devastating to his family. So I'm encouraging my clients to evaluate what life insurance they may own in their own names and move them out before the end of this year, set up a life insurance trust and move it out before the end of this year in order to avoid that result. Okay, now please advance the slide. I always like to see if she's actually paying attention. So, I'm trying to get her on her toes. All right, so I just talked about the 2022 exemption, which is $12,060,000, $60,000 per person. They can never use round numbers because they like to trip up lawyers. But fortunately for me, I work with accountants, so I'm okay. So that's $24,120,000 per couple. And what that means is that's the amount that you can give away during your lifetime or in the aggregate. And then at the end, whatever you have left over after we deduct all of your gifts and what you have remaining in your estate, if that number is over the exemption amount, the amount over will be taxed at 40%. So let's say that Jen does very well. She has an estate worth $20,060,000 on her death. She wasn't particularly generous during her lifetime, which comports with what I know about Jennifer. She will then have an estate tax based on $8 million. That's $20,060,000 less $12,060,000. She'll have an estate, that taxable estate of $8 million. And that $8 million will be taxed at 40%. So that 40% then will be $2.4 million. So had Jen called me instead of just dying with $20,060,000 in her bank account, we would be able to do some planning in order to move that around and avoid that $2.4 million. In 2023, the exemption goes up to $12.92 million. That's $25.84 million per couple. And again, I had this checked with some people on my team, so I'm pretty confident in the numbers. But you're welcome to do the math yourself. So that's pretty high. And the projection is that there's only like less than 1%, less than 0.5% of all people in the country are going to actually be subject to an estate tax, particularly if they're able to do some planning before, while the exemption is so high. And then one of the things, though, that I'm really spending a lot of time talking to people about, not just the life insurance question, but the thing about estate planning, estate tax planning really specifically, is that it's all about when and how you give away your assets. Because essentially you have two choices, right? You can make transfers during your lifetime or at your death. Those are your two choices. If you decide that you want to make gifts during your lifetime, it's really important that you talk with your advisors and make sure that you have the cash flow to sustain it. A bad plan, and I've seen this happen, is when you make all of these gifts, you do some great estate planning, and from an estate tax perspective, you did a great job. You reduced your estate tax. There's going to be no estate tax at the end of the day. Good job. Except that in 10 years, you've got your hand out to your kids. That would be a failure, in my opinion. I would want to see a better plan put together where you have the resources to sustain your life during your lifetime while also mitigating an estate tax. Can you advance the slide, please? So it's important really that we we work together as trusted advisors. It's attorneys do a great job of drafting the documents and putting the plans together and really crafting really creative plans. I'm very fortunate to be able to work with some of the best planners in the country on those plans. But the benefit of involving your accountant, the benefit of calling your SACS trusted advisors, is that they can then make sure that you are managing your cash flow needs and making sure that you're going to be able to sustain the plan that's put into place. It's also another reason to involve your financial advisors. The financial advisors should be aware of the investment strategy, they should be aware of the planning, and they should make sure that the investment strategy complements and really meshes well with whatever the planning, the estate tax plan is that's put together. Additionally, you want to make sure you have good trustees. While it's much more convenient to have, well, not my brother-in-law, but maybe somebody else's brother-in-law to be your trustee, sometimes, Uncle Jack isn't exactly the right person to be managing those assets for the benefit of future generations of your family. And you're going to want to look for someone who has a little bit more financial and legal acumen to be able to protect your kids' assets and the assets for the future generations of your family. So we would want to talk with you about what's going in that trust and what are your plans for it and what are your plans for your family, and is there any way that we can bolster that plan by having a good trustee managing those assets. Additionally, if charitable planning is part of your strategy, you're going to want to make sure you're communicating with the charities. Next slide. General thoughts. Charitable planning is near and dear to my heart. It's really an important part, I think, of any tax planning strategy. Because, as a result of the Tax Cuts and Jobs Act, and most people realize, there aren't that many income tax reductions that we can use other than charitable contributions. I mean, there's certainly some, but charitable planning can certainly save a lot in income taxes. Additionally, while people want to be charitable at their death, lots of people want to make, that testamentary bequest. Testamentary is just a fancy way of saying at my death. But there are people who want to make testamentary bequests, and that's all well and good, but you're going to probably get a better tax advantage by making those contributions during your lifetime. So that's something that I really want to make sure that people are aware of. And of course, towards the end of the tax years, when you're going to want to be looking at your portfolio, seeing what your income tax liability is projected to be, and then deciding whether a significant charitable contribution is important for you to be making. What I also would want to emphasize, and this has been emphasized to me in multiple seminars and webinars that I've been part of, from the planning aspect of it, but as a donor, if you're not feeling charitably inclined, don't make charitable contributions just for the tax advantages. It's usually not really worth it. At the end of the day, you're going to have to give something up in order to get that deduction. And what you're giving up is usually, usually in dollars, right? More than the deduction or the tax advantage that you wind up getting. So here's some charitable planning strategies, and I've put them in order of complexity. We do not have time in this webinar to get into some of the more complex and, in my opinion, interesting tax charitable planning strategies, but I do want to make you aware of them. So, of course, the first one is the easiest: annual cash donations. You want to make a contribution to the Friends of Israel, you can just write a check, and that would be probably deductible on your income tax return. Perhaps you want to make a more sizable contribution. You're looking to bunch up your deductions, so you want to set up a donor advised fund. Additionally, you can make in-kind donations of appreciated assets, We're going to talk about qualified charitable distributions because I think they're really interesting and very valuable tool for plan participants who are over 70 years old. I did mention testamentary bequests. Again, that's what you do during your, in your will, as opposed to during your lifetime. I think that's the kind of thing that we do kind of towards the end, that like the last type of transaction that you're going to be looking to do if you were looking to create some kind of a legacy, because in terms of tax benefits, you're going to get a better benefit from the A through D here. Then there's charitable annuities and charitable trusts, much more sophisticated strategies. So again, annual cash donations are attractive for their simplicity. These are going to be deductible up to 60% of your adjusted gross income through 2025. Then that law is going to sunset and the percentage might be different. It's going to depend on whether Congress is able to, agree on something more permanent. So my thought, and I wanted to make this point clear, is that by making sizable annual cash donations, you could be missing an opportunity for a larger income tax deduction and for some opportunities to do some estate planning with your charitable planning. So I'll bring some of those up as we get through it. And then just be aware that it's deductible up to 60% of your AGI for 2022. Can you advance the slide, please? Donor advised funds are great. So what ordinarily happens to me is I start the conversation with someone and they say, I really want to set up a private foundation. And I think I understand the need for that, or the interest in that. I love the idea of a private foundation because it gets your family together. They have to sit around. They have to say, hey, what did mom really want? What did mom really care about, right? I have 4 kids, and the idea that they would come together as a family on a quarterly basis to discuss my desires and my needs and my wishes for a better community or whatever is very appealing to me, and I get that. And that's usually what I hear from my clients when they talk about the reason that they want a private foundation. Fortunately, donor advised funds can serve the same purpose. And the difference, at least from my perspective, at least from what I understand, is that the private foundation requires that you get private foundation status. You actually have to actively apply for that with the IRS, and then you have to maintain it by filing all of this paperwork and meeting certain regulations. It's a heavily, as you can imagine, a heavily regulated industry because they want to avoid fraud. A donor advised fund also allows your family to, build up a pool of resources, meet regularly to discuss where those assets are going to be donated, where those proceeds are going to be contributed in order to further your charitable purpose and your charitable desires. But the family is not going to be required to go through all of the regulatory, hoops that you would have to go through for a private foundation. Generally speaking, I know that with our Sachs Wealth Advisor firm, you would be able to just fill out an application, write a check, and you've got a donor advised fund. And the cool thing about it is you can name it anything you want. So if you wanted to name it, the Jen Moreau's Fund for green grass, you would be able to do that. And that could then be the purpose of the donor advised fund. Okay, do you want to go to the next one? Low basis stock is a hard one for some people because they don't want to sell it. Because if you sell it, you're going to have a significant capital gain, and nobody wants to pay the significant capital gains tax. So if you're already charitably inclined, perhaps instead of making a cash gift, you can transfer some of those low basis stock over to a charity and then get a full charitable contribution deduction for the fair market value of that stock without having to sell it first. There are some rules. It needs to be long-term capital gain property and not short-term or ordinary income property. And you want to make sure that you are, and if you exceed the limits, you would be able to carry forward the deduction for 5 years. it's important to make sure that you're meeting the charity's rules and requirements for transferring those funds. The charity is going to need to have a brokerage account to accept the shares and a policy on how to handle the investments once received. But most major charities already have that. Okay, QCDs, these are great. Qualified charitable distributions. If a donor is 70 and a half or older, instead of, they're required to take, or they're not required to take required minimum distributions anymore. Required minimum distributions are required now at 72. So let's assume that the donor is 72 years old and is required to take distributions from their IRA every single year based on their life expectancy. Assuming that that life expectancy payout would be about $100,000 a year, that would be ordinary income to the individual. And for some higher net worth individuals, perhaps they don't need another $100,000 of income. Plus, they probably don't want to pay or income tax, ordinary income tax on that $100,000. So instead of doing that, what they could do instead is make a qualified charitable distribution, which goes directly from the IRA to the charity. So it never touches the plan participant. So Greg, who's probably the youngest person on this call, but let's just assume that he's 73 years old and he's required to take 100, and he did really, really well because he invested his IRA was being managed by Sachs Wealth Advisors, and it's just done really well, and he's supposed to take $160,000 a year in required minimum distributions. And so he's 73 and he's saying, I have a lot of other money, I have a lot of other investments, and even though he's supposed to retire, he's decided he just wants to keep working. So he has his own income. He's ready to go. He's got everything he needs. We force him into retirement anyway, and so now he's got other assets that are generating enough income. He doesn't need the $160,000 from his IRA. So what Greg is going to do is he's going to tell his IRA, hey, instead of giving me that money, can you give $100,000 of it to this charity? And then the charity is going to appoint, we'll have a trustee that it appoints to communicate directly with Greg's IRA. And that $100,000 will completely bypass Greg. He never gets that money. It never touches him. And it goes right from his IRA to the charity, and that then avoids being picked up by him in his individual income. So what have you accomplished? Instead of getting a $100,000 charitable contribution deduction, which basically works out to be, a 30% benefit, right? If your income tax rate is 30%, that $100,000 never touches your income. It never goes into your taxable income amount. And as a result, you're able to completely bypass it. Further, the donation is not subject to adjusted gross income limits. It's a pretty sweet deal. So here's a handy slide. I believe we're providing the slides for you so that you can look through this. Just a little bit of an informational here. Your tax advisor at Sachs will know this information, but this is just to give you an idea of what kind of charitable contributions you would be able to deduct. So cash is 60% of adjusted gross income. If you were to make a cash contribution to a donor advised fund, you still get the 60%. If you were to transfer appreciated stock, it's a 30% of your adjusted gross income limit. You would be able to carry that forward for 5 years. If you are not able to take a charitable contribution deduction for whatever reason, or if itemizing doesn't work out for you, you could get up to a $600 deduction for cash donations. Advance the slide.
All right, thank you, Joy.
Greg, hold on, Greg. I think there was a couple of questions in the queue that we would just want to answer because they pertain to Joy's section.
Sure.
I think maybe we'll just take care of those now instead of waiting until the end.
Absolutely.
So the first one is, are you talking about term life insurance or whole life insurance?
So it really wouldn't matter. If you own a life insurance policy on your own life, then at your death, the policy is going to be, the policy proceeds will be includable in your estate. What happens when someone dies, we take a picture of all of the assets that are in their name. So on my death, everybody's happy to talk about my death, not so much their own. At my death, we take a picture of Joy's assets. And at that moment, any life insurance policy on my life is going to have a value equal to the policy proceeds. And that's any policy, whole life, universal, term, and all of the hybrid policies that are available out there. So at that moment, we take a picture, it's worth $5 million. Now I have a $5 million asset included in my estate. Now, the advantage of having a term policy in your own name, if there is any advantage, is that it probably has a very low cash value. So moving it into a trust, which is going to be valued at the cash value is going to essentially be the amount of the gift that you're making to that trust, will likely be rather low. Whereas with a whole life policy, I would expect the value to be relatively high, and we would have to really think through how we would move that policy into a trust so that you don't have a significant usage of your lifetime exemption. Any other questions?
There's one more. It says, can you please clarify the life insurance matter? If there's an assigned beneficiary, how does the life insurance proceeds go to the estate?
So the life insurance, now that's actually a great question, and I'm glad I have an opportunity to clarify. The life insurance proceeds go to the beneficiary, but they're considered to be an asset of the estate. So let me say that again. And the proceeds, so again, I like a $5 million policy. I think that's just because that's the policy on my life. Jen, you're not the beneficiary, so don't get any ideas. But so I've got a $5 million policy. Greg's got a $5 million policy on his life, and he owns the policy. And he's named Jen as his beneficiary of that policy. So on his death, Jen gets the $5 million in cash, and she goes off and does whatever she's going to do with it. But the estate has an asset now worth $5 million. And assuming that that $5 million is the amount that by which his estate exceeds the exemption, let's just assume that for simplicity purposes, 40% of that policy, $2 million, is going to be your estate tax. So the estate is going to be required to pay an estate tax on that $5 million. And actually, the bill is going to be $2 million. Now it's going to that estate is probably going to have to find $2 million from its own assets, because Jen's already taken her $5 million check off into the wilderness. Who knows where she is now? And so you've got a $2 million bill with no asset against which to offset it. The estate has to come up with that money. It's a terrible result, and it could actually happen unless different planning is put into place, which is why I really do encourage people, take a look at those life insurance policies. Let's figure out what needs to happen with them, and then let's do that before the end of this year, because while we have a really high exemption, you've basically got 3 years in which to pass when you won't have to worry about an estate tax because your exemption is so high. When the exemption is back down to earth in 2026, it's a $6.5 million exemption. That $5 million asset could be a real problem for people.
Okay, thanks, Joy. We're going to move on to Greg and portfolio allocation.
Yep. Thanks, Joy and Jen. And good morning, everyone. My name is Greg Munn. I am a certified financial planner and CPA at Sachs Wealth Advisor. Some things that we're doing with our financial planning, a large part of that is dealing with tax impacts. And specifically when we get into your portfolios and some IRAs, most people have a few different types of accounts. Qualified accounts are your IRAs, 401ks, and 403bs, those types of things. The investments inside them throw off interest, dividends, grow hopefully, and you do not pay tax on any of that growth or interest and dividends until you take money out later on when you retire. Your non-qualified accounts are your brokerage accounts. You get a 1099 at the end of each year telling you how much you earned in interest and dividends, and you have to pay tax on it. People may have a Roth IRA as well as a third bucket, but we'll just kind of ignore that for now. So then it's important, what type of investments do you put in each of those buckets? You know, you have stocks, bonds, mutual funds, ETFs, REITs, real estate investment trusts. You can have holdings in the US or internationally. And all of these different investments have different tax consequences. Ordinary income items are bonds and real estate investment trusts. So the interest that those pay out, if it's in your non-qualified account and you have that 1099, you're going to pay tax at your ordinary income tax brackets, which right now could be as high as 37% with the IRS. And depending on what state you're in, it could be, you know, maybe 10% there as well. Certain stocks, US stocks specifically, are considered qualified income. They pay out qualified dividends. Those are your friends. Those types of investments you would maybe want to put in your non-qualified accounts. That way, when you get that 1099 at the end of the year and you pay in tax, the qualified dividend maximum tax rate is 20%. So obviously, depending if you're a high income person and you're in a 37% ordinary tax bracket, it would be better off if you to have qualified dividends in those non-qualified accounts and pay lower tax brackets. Bonds, there's a difference between municipal bonds or taxable bonds. Municipal bonds are issued by the governments and you do not pay tax to the IRS on those. Taxable bonds, corporations, things like that, they issue bonds. Any interest on those, again, are ordinary income and you would pay tax on it at a higher rate. So maybe you can put some taxable bonds into your qualified IRA account to shield those from tax. If you need municipal bonds, you would put those into your non-qualified accounts. One important thing to keep in mind, though, is when you're comparing municipal bonds versus those taxable bonds is computing a tax equivalent yield, meaning if you know what the municipal bond is paying, what rate would you need to get on an equivalent taxable bond to where after you pay the taxes, they end up being the same. And it's a pretty simple formula. You take the yield on that municipal bond, divide it by 1 minus your tax bracket. An example, if a municipal bond's paying 6% and you're in the highest 37% bracket, that would come out to being equal to a 9.52% coupon on a normal taxable bond. Next slide. So then we move into another thing that mutual funds pay out. You would not have this with individual bonds or stocks, but mutual funds are a great way for people to invest their money, get things more diversified. And throughout the year, those mutual funds, they're trading, the manager on those are buying and selling stocks or bonds, and they're likely generating gains inside that fund. So what they must do is at the year end, they have to distribute those built up gains to the shareholders of that mutual fund. A lot of investors, I believe, came privy to this last year in 2021. It was a good market year, and a lot of people were caught by surprise at the end of the year with their funds paying out large amounts, and you have to pay tax on those. 2022 is not set up to be as good of a year as last year, so I would anticipate those payouts to be lower, but there are still some mutual funds that still have built-in gains that have to pay out by the end of the year. So it'd be important for you to check on those mutual fund websites to see if you can get an estimate on what that distribution may be, and then you can plan around that. There are some alternatives to just standard mutual funds that pay out these year-end capital gains. You can avoid this by investing in things like exchange-traded funds, or some mutual funds have a tax-managed fund separate from their typical mutual fund where they try and keep those year-end distributions lower, so you don't have a tax scare at the year end. Next slide, please. And then one other thing, dealing mostly with your non-qualified account. Again, this year, 2022, is not set up as well of a year. So there may be some positions you have that are at losses currently. So it could be a good opportunity for you to do what's called tax loss harvesting. And what that is it's an opportunity for you to sell positions that are in a loss, generate a tax benefit. You're able to deduct up to $3,000 each year on your tax return. Or you can also use those losses to offset any positions you may have in gains. And any excess losses that you have, you can just simply carry forward and can be used in the future. A little bit of a more exciting strategy is if you have gains in your portfolio, maybe you have an opportunity to tax gain harvest. Hopefully everyone would have that issue, but that would be your opportunity to sell any positions at long-term capital gains. You want to wait until those positions are at long-term over a year, because the maximum long-term capital gain rate is currently 20%. If you sell a fund at a short term within a year, it's taxed at your ordinary income brackets, and like I said before, that could be as high as 37%. And depending on your income, if it is low enough, 41,000 if you're single, 83,000 if you're married, so that would most likely be someone who is retired. You could potentially pay 0% in long-term capital gains rates as long as your income is below those thresholds. So again, if you have some positions that are in gains, maybe able to sell some of those, spread the future tax burden over multiple periods, or you may have some lost positions that you can use to offset those. Next slide, please. All right, so now we'll get into some IRA strategies. The previous slides dealt with your non-qualified accounts. What can you do with your qualified accounts? With the IRAs, first I just want to point out and explain a couple things. The Secure Act changes, required minimum distributions. Previously, you had to begin those when you turned the year you turned 70 and a half. That is now age 72. So whatever year you turn 72, you have to start your distributions. Government's been talking about increasing that possibly to age 75, and they may do that over a period of years. Nothing is final yet, but hopefully they can keep delaying that if you do not need those distributions. Those distributions must be done by December 31st each year. In the first year of your distribution, it's a little tricky. You actually have an actual added benefit. You could delay taking those distributions out until April 1st of the following year, so essentially by tax time. The only downside to doing that is if you delay your first year to April, the next year you now have 2 distributions, because every year following that first year must be done by December 31st. So something to check with your tax advisor on whether you should take it this year, or if you want to delay until next year for a few months, and then you have double the RMD to report that time. The penalty is stiff if you do not do your distributions by year end or on time. It's 50% of the required amount. So make sure you're staying on top of that. This time of year, we are going through with all of our clients to make sure those required minimum distributions are taken care of. Let's see. So kind of a little point I just wanted to put in here. If you had taken out money from your IRA for COVID purposes a couple years ago, you are able to pay that money back. So if you do have that ability, you needed that money then, but now you've gotten back together, got a job or whatever it may be, you could, and you have the funds, you could pay that money back and adjust your prior tax returns and possibly get a refund back because you've been paying tax on that money these past 3 years. Something that's not listed here also goes along with the Secure Act changes. When you die, someone will inherit your money, your IRA. If it's your spouse, they can treat it as their own IRA, and they will be able to take their required distributions on that inherited IRA over their life. For others, so let's say your kids inherit your IRA, the law now says that they have to withdraw all of that money within 10 years. Previously, they were able to stretch it over their lifetime as well. That is not the case anymore. So
Yeah, so
very
if I may, so Greg, so that actually then raises some issues and some questions that we've been talking to our clients about in terms of how to write those beneficiary designation clauses on your IRA. You need to be very strategic in how to do that because the new rules are going to essentially require your heirs to pick up in their ordinary income, because IRA distributions are considered ordinary income over the first 10 years, and then in the final year you have to take the whole lump sum if you haven't taken it before that. Every year the new Secure Act regulations require that those RMDs, required minimum distributions, are paid to the beneficiary based on their life expectancy, and then at the end of the 10th year they have to take the final amount. So there might be some different things you want to be talking about with your advisors. That's definitely something we're going to talk about if you call us for estate planning. You really want to be very thoughtful in how you make those contributions, or how you designate those beneficiaries of your IRAs.
That's right. All right, next slide, please. So then what else can you do with your IRAs? A big thing we're looking at are Roth conversions, taking advantage of low tax brackets that we currently have. I would bet that the government at some point will be raising tax rates. The current laws are already set to expire after the year 2025 and possibly sooner. There is no limit on the amount that you can convert. You basically take money from your IRA, move it over into your Roth IRA. You pay tax now on the amount that you choose to convert. And it's as simple as that. It reduces your future required minimum distribution. Money that your kids would now inherit in a Roth IRA, they still have that 10 years from the Secure Act to withdraw that money, but they will never pay tax on that Roth IRA money ever again. And you're effectively trying to smooth out your taxes throughout your retirement. Next
And this
slide.
actually could also be a good estate planning technique, because what it does is it reduces the size of your estate by those taxes that you're paying. So we've had clients, kind of towards the end of their life expectancy, and for those particular clients, we've talked through and mapped out exactly how much they can save from an estate tax perspective by paying an income tax now. But that has to be very strategic, and after everything else is done, if estate planning is the reason for doing it. But to Greg's point, it is a good way to smooth out your retirement, because you'll be able to take those tax dollars, or those IRA dollars, without tax liability at a time when your income is more fixed.
Yes. All right, so the next area, that all dealt with your portfolio. A set of individuals are those that are self-employed. They have a little bit extra strategies at their disposal that they can be doing tax-wise. First being along the lines of getting your business set up properly. Should you be an LLC or a partnership, those tend to give you more flexibility. But you have to pay self-employment taxes on those sort of entities. 15.3% is that self-employment tax. So maybe depending on the income, it may make sense to elect to be an S corporation or C corporation or something like that. You, as a self-employed, you have a little bit more control on the timing of your income and expenses. We always tell our clients at the year end this time, if you're expecting a payment, in the next month, maybe you can call that person and say, hey, why don't you delay that and pay me January 1st? That way you push that income into next year. Same thing on expenses. If there's a future expense and you need that now to save money, maybe you can prepay that expense now. Just wanted to make sure people, if they are self-employed, take advantage of the ability to deduct their home office. If you're using your automobile for purposes, you can deduct those as well. There's the Augusta rule. Not sure if anyone's heard of that, but it's created from Augusta, Georgia, where the Masters is held each year. What that is as long as you rent your house out less than 14 or less days a year, you do not have to report any of the income from that rental. So again, people that live in Augusta rent their house out for the week during the golf tournament, make a lot of money, and they do not have to report any of that income because it's less than 15 days a year. If you have any children, you can pay them to work for you and your company. There is an IRS case that backs paying your children up as low as 7 years old. So don't pay a 5-year-old, but if they're at least 7 years old, you can have them do some work for you and compensate them for that. That's a good way to put that money into a college savings plan, some vehicle like that, make college tax deductible. MERPs, medical expense reimbursement plans, depending on what your spouse's job, what their health benefits may offer. You could benefit by instituting a MERP with your business. And then Jen's going to take us through a lot of different retirement plans that you can set up.
Thanks, Greg. So this section of the presentation is going to talk about different types of employee benefit plans, retirement plans, IRA, Roth IRA, a SEP IRA, a solo 401k, 401k with profit sharing, and then we'll talk about defined benefit plans. So there's advantages and disadvantages to each one of these. So this is where tax planning is very important, and discussion of what is your objective, who are you targeting and trying to benefit, and then how much are we talking about in terms of cash flow, because obviously there's limits with respect to IRA and Roth IRA, and then when you get to defined benefit plans, there's a very large limit that one can contribute, but the cash flow needs to be there for a significant number of years in order for this to be sustainable. So we're going to talk about regular IRA. This is basic. It's for a self-employed individual or an employee that is not eligible to participate in a plan. So if you are eligible to participate through your employer, you can have an IRA, but it's not deductible for you on an individual basis. The benefits to this, it's easy to set up and maintain. You can set it up after year end. You don't have to contribute every year. The drawbacks here, low contribution amounts, and the deductibility is limited if you're covered by a plan like previously stated, or your modified adjusted gross income is too high. Again, low contribution limits, you're limited to $6,500 per year. You're over 50 years of age, you're allowed an additional $1,000 catch-up contribution. Again, a benefit here, there's no tax filings, and you typically receive a deduction for the contribution. You can withdraw this money at any time, but there is a 10% penalty if you're under 59 and a half years of age. So we'll talk about Roth IRA. Again, very similar to an IRA, except it's after tax contributions. You're a self-employed individual or employee. Same, easy to set up and maintain, set up after year end. You don't have to contribute every year, which is a benefit. Again, though, low contribution amounts, and it's limited if your modified adjusted gross income is too high. Same as an IRA, you can contribute $6,500 with an additional $1,000 catch-up if you're over 50 years of age. The only difference here is distributions are not taxable, but you need to track the 5-year aging for distribution purposes with when you can and cannot take the money out. Next one, which is a SEP IRA. So this is for self-employed individuals or small business owners that have a couple of employees. So you can, have you and a few employees and contribute the amount. Again, this is a very easy to set up. It can be established after year end, as long as it is established and funded prior to the tax filing deadline. There's flexible annual funding requirements, but the same amount goes to everyone, including the owner. So it's typically a set percentage of everyone's compensation, but everyone gets the same amount. There's no 401k contributions or contributions by the employee. It's solely funded by the employer, which is up to 25% of compensation to the max of the $66,000. That is the limit for 2023. benefit, there's no employer tax filings, and same as everything else, you can withdraw the money at any time, but if you're under 59 and a half, there is a 10% penalty. Solo 401k. So this is for, you cannot have employees with this. It's for the self-employed individual or business owner, but it can include their spouse. So this allows the 401k contributions. So it allows a potentially higher contribution than the SEP IRA. It's less administration, but there are filings that are required if the assets are over 250,000 at any given point in time. So with the solo 401k, you are allowed to contribute the max deferrals of 22,500. If you're over 50, you can contribute the catch up. But you can also contribute 25% of compensation up to the max of 66,000. So that 66,000 includes the 22,500 of deferrals. Withdrawals can be taken if you're 59 and a half or for disability or plan termination. The drawback here, it has to be set up by year end. You can't set this up after the fact. So this is something to look at now in order to set up for 2022. 401k and profit sharing. We look at this generally for companies that are a little larger, have at least 10 employees, so that there is a benefit, and the benefit outweighs the cost and administration of setting, these type of plans up and maintaining them on an ongoing basis. 401ks and profit sharings have flexibility in design, but do require administration, an investment advisor, and education. So you need to have an outside custodian or third-party advisor and an investment advisor on an ongoing basis to maintain these plans. That's why they're more expensive and burdensome, and we suggest having significant employees to make it worth it. The salary deferrals are the same, 22,500 in 2023, plus a catch up if you're over 50 and a half. For the profit sharing, it can be discretionary. You can have a discretionary match, safe harbor, up to 25% of compensation. The limit is still going to be 66,000 per person, which includes the 22,500 of deferrals. 401ks do require 5,500 to be filed on an annual basis, and annual testing that would be done by the third-party administrator. The other some advantages are you can allow loans and hardship withdrawals can be available with these types of plans. So the 401k does have to be set up before year end, but the profit sharing can be decided. If it's a discretionary profit sharing, it can be decided after year end in order to use that for tax planning. So that's something that can be discussed after year end, and as long as it is funded by the tax deadline. Defined benefit plans. So we talk about these, a lot of the times we talk about cash balance plans, and you can add them onto an existing 401k. It's technically a separate plan, but we use them in conjunction for tax planning purposes. So they're appropriate for companies that are consistently profitable and have significant cash flow, but not very large companies because it becomes very expensive to fund. So they're usually, the sweet spot here is 10 or fewer employees with an older owner. So they're flexible in design, but they require same administration and investment advisor. They're the more expensive type of plans and are administratively burdensome because there's a lot of, you're using an actuary and not just a third-party administrator and custodian. There are annual funding requirements, so you can't have a great year one year, contribute, and then not contribute the next year. We suggest at least a 3-year commitment to these types of plans, so you need to have consistent cash flow. The cash balance defined benefit portion of the plan is funded solely by the employer, but the benefit is it's up to 265,000 per person. So that's why when we set up these types of plans, we try to maximize the amounts going to the owners, but there are contributions that have to be made to non-highly compensated employees. There is a 5,500 requirement and testing by the plan actuary, and withdrawals, same as everything else, and it must be set up prior to year end. This isn't something that can be done after the fact. To show you a quick real world example of something we've presented to a client, they had a safe harbor 401k and profit sharing, and we suggested adding a cash balance option. At the time, they had approximately 12 employees, I should say, and 3 owners. So the total contribution we were suggesting would be $265,000 to the whole plan, which would have a tax savings of about $120,000 to the 3 owners. But the contributions to the staff were only $79,000. So you can see here, if they made this total contribution to the plan, they were getting most of the money. The tax savings clearly outweighed the contribution that needed to be made to the staff. So these are very useful, and you should talk to your tax advisor, your third-party administrator, or Sachs Wealth Advisors to help you out here.
And the last thing that we had was just to kind of give a quick glimpse on the Inflation Reduction Act and what it's trying to achieve. It's a lot of things around residential clean energy, energy efficiency, those sorts of things. So there is an electric vehicle credit up to $7,500. However, those credits start getting phased out and stop once 200,000 units of a vehicle is sold. So if you may like a certain Tesla and they've already sold 200,000 units, you may not get that full credit. So something to keep in mind. Premium subsidies for healthcare are planning to be extended through to 2024. Another future benefit is the goal of this act is to try and lower prescription costs beginning in 2025, where there may be a $2,000 annual maximum out of pocket at that time. They wanted to raise the C corporation minimum taxes. Right now that rate is 21%. The residential clean energy credit is upwards of 30% credit for any solar panels that you may install in your house. And then some other energy efficient home things you could potentially do if you're looking to get a heat pump, energy efficient windows, doors, insulation. You're looking at maybe $1,000 to $2,000 credit available for that per year. So just to give you an idea of what that act may involve. Next slide. And that's it. Let's see if we have any other questions.
I think we answered the question on the cash balance plan. I don't know if there was, yes, the employer would be liable for losses and there's funding requirements. So yes, that would be taken into effect. That's why these are risky, and it's not easy for everyone to be, you know, to absorb that risk and go into this type of plan. And again, if there's any other questions, feel free to reach out to either one of us individually. We thank you all for attending, and everyone have a great day.
Thanks, Jennifer.
Thank you.